Welcome to American Dreams. I'm visiting here today with Robbie Shattuck. Robbie, welcome to today's show.
Thank you. It's good to be here.
So, Robbie, for the listeners, can you give your background of how you got to where you are today? And let's start out of college.
Yeah, sure. So if I go back to college, I went to school at BYU. So I was a Brigham Young University student there. When I got to school, I wasn't quite sure what I wanted to study. And so I spent a good portion of my first year figuring out, is it psychology, biology, did I want to go into finance? Spent a long time there and ended up studying actuarial science, which usually is not most people's preferred field. I think that the average number of students there was about 20 that were studying that. And it's a mixture of math, statistics, and economics. During that process, I did a number of courses, did a number of internships, and realized that while I loved studying the numbers, I love people. I love working with people and helping them solve problems, and learned quickly that I did not want to be an actuary. And nothing against actuaries. I think they're great people and they do a great job, and I have a lot of friends who are. But I realized for me, I wanted to be out there talking to people. And so fast forward a little bit, and I got my first job out of school. And to get there required a lot of work. But my first job was at JP Morgan. And so I got a job with JP Morgan in San Francisco. And it was my dream job. It's something that I had worked so hard over the past probably decade leading up to that to get a job that I felt like I could work with individuals, and I was in their private bank. And so their private bank, to give some background on that, is helping high net worth individuals manage their investments, help them think through their estate planning and tax strategy at a high level, and coordinating with external advisors as well. And while I had that dream job, after only a few years, someone came knocking on my door. My former boss actually left and went to this other firm that kept stealing all of the JP Morgan clients. And so I said, well, if they're stealing the clients, I should probably figure out what's going on there. And so that firm was called Iconic. And so I quickly jumped ship and went to this firm called Iconic. And it was something that was it was different. They were doing things differently. They had a different approach. And there at Iconic, I spent my time working with, I'd say, some of the brightest minds in technology today. I can't name names of who those clients are, but they're tech founders and entrepreneurs whose companies have gone public for several billion dollars. Each of them typically are a billionaire in their own right. And that experience was something that I'd say most people would never get in their entire career, even if you're in wealth management. And working with individuals of that level of wealth, but also the level of complexity that comes from just working with them. Think about it. You talk to an individual who's been working on a startup forever, and it's a private company, and then have the benefit of helping them out and think through what decisions should they be making when going from private to a public company. And then all of that comes with it. Your company goes public, there's so many different changes. So I spent a good amount of time at Iconic, and then there came a turning point in my career where my wife and I were talking, and we were just trying to figure out. She said, I can tell you really like your job, but something seems off. And I said, well, no, everything's great. I love my job. Like, it's going well. And then I started to reflect and think about things and take a step back and look at life. And here we are. This is 2020. We're in the middle of a pandemic. It's a different year. But I'd say about 3 months before that happened, December of 2019, I realized that I needed to make a change. And so I spent time actually speaking with a lot of, I'd say, friends, mentors, individuals who are in the wealth management, private banking, family office space. And each of them gave me a different piece of advice. And so I gathered those pieces to create my own painting. I had all the colors that they each gave me, and I had to paint my own picture. And so I decided, rather than taking a job, and I received several job offers, some of them, I'd say, very, very good offers that would leave me very comfortable for the rest of my life. I turned down to walk away from a very good paying job to start my own business. And I'd say it's probably one of the scariest things I've done. I don't know, maybe they were scary things, but for me, it felt very scary at the time. Walking away from a job where you're working with billionaires, it's kind of like everyone's dream to be doing that. And why would you leave that dream? And for me, I wanted to create my own dream. I was ready to be an entrepreneur and build up a business. And so I've spent the past year actually building this business up. And now the business has gone so well. I'm very excited about where it is, but also where it's going to go. And now at this point, I'm working with individuals kind of across the board. And that's the long version of it, but that's how I get from college to Athos, which is where I am now.
How has COVID affected you this last year?
Great question. COVID usually for me, my business is, you could say I'm a startup. Now in wealth management, it's not quite a startup, because a startup is usually you have a product and you hope that business will grow. In wealth management, I have a skill set. So I'm a professional services business individual. And so individuals work with me because of my skill set as opposed to a product that I'm giving them. And I found that COVID is actually very beneficial in lots of ways, because for me, I can touch and speak to so many more people than I probably could have. Just the travel alone. I have clients in 5-6 states right now already. And if I were to try to go from Washington to Utah to Texas and back to California and then cross over to New Mexico, the travel would get expensive, but also just time consuming. And so I found that a COVID year is actually, while hard, is actually probably one of the best times to start a business.
So Robbie, as you get started, of course, startups we have our ideal situation and then a reality as we move through the startup. Currently, do you have employees, or is it just you?
Yeah, it's just me. I am looking to hire over the next 12 months,
Okay.
but it's going to be very slow. And I think COVID is also making me think think a lot about what I'm doing. I'm based in California right now. I will actually be relocating to Utah to continue growing and building my business. A lot of that is also, there's a new ecosystem there that is really growing. And so being able to tap into that. But as I think about employees, the big thing that I think about is everyone's virtual right now, or for the most part, if you're in a business like this. And I work with individuals who are, when you see their level of wealth and you see information, whether it's a social security number, birth date, some of those basic numbers, but then also just access to their financial well-being. I'm very concerned about privacy and security. And hiring new employees during, I'd say, a virtual year, I have to be very aware of that. How do I hire employees and train them up and know that they are going to protect this data? And so for me, normally I would probably be at 2, 3, 4 employees by now. And instead I'm actually going a little bit slower, which makes my job harder. But I've got to find the right people, train them up, and be able to sit next to them, at least for a while, and make sure that there's that level of trust there.
So you moved from a relatively large firm working as teams and into the startup. And as you launch this company, what is your ideal client?
Yeah, the ideal client for me, if I were to take a step back a little bit, most wealth management firms kind of say, we work with wealthy individuals. That's, if you were to say that, that's a lot of people. I take a much more narrow or niche focus on my clients. The ideal client, if you were to say who would work with Robbie and who would fit well with my skill set, it's 2 groups of individuals, I'd say. And I kind of split that 2 ways. First are technology founders, entrepreneurs, or professionals. Why? First off, my experience, my past experience has been with tech founders, entrepreneurs. I understand what it takes to go from nothing to billionaire. And I've seen from 0 to billionaire and everything in between, and also see the issues that they run into when you go from that point. But then also, if you were to really take a step back, most companies these days are tech companies. I would argue that GM is a tech company now. Yes, they do make cars, but their acquisition of Cruise, everyone's focusing on automated driving. So that's probably a broad statement, but I focus a lot on tech entrepreneurs who aren't yet public, the companies are still private, and there's a lot to think through. So I think the planning, and in your job as well, planning with individuals at the beginning is so important. It's better to do early on than too late. And then the other type of client that I work with are individuals who have a lot of exposure to those tech companies, which are private equity, venture capital professionals. I work with a lot of those because the issues that they run into are actually very similar when it comes to acquiring a concentrated position. How do you manage that position? What do you do when you're ready to sell? When do you sell? When do you figure out the timing? What about the whole tax piece? There are a lot of components there. And so I focus a lot on individuals who have gained their wealth through that. I do have clients who also touch other areas, but generally speaking, those are the ideal clients. And the reason I say that is just my network being here in Silicon Valley. There's just a lot of synergies that happen in working with individuals who cover those two specific areas.
Recently, there was a $10 billion private equity fund that, well, he had raised the money, he was sitting in cash, and was focused on value investing. And due to circumstances in the market, he turned around and says, I'm going to just refund all your money back, and I'm not moving forward. So the testimony there is we clearly have changed from what it used to be to what it is today. How would you advise one of your clients on if they were coming in with a lot of cash today, areas that they should be focused in on to have not only diversification, but to also try to realize how do you mitigate all this uncertainty in the world?
Yeah. Yeah, that's a great question. When I work with my clients in general, you think about a balance sheet. It's not just the investment portfolio, but it's the full balance sheet. And so I take a step back and look at the holistic picture. You have your home, you've got your cars, maybe you have an investment property, maybe you have something else. All those pieces play a role into how we think about actually investing. But then when it comes to the investment portfolio, it's always a discussion, and it's an evolving discussion. And that's one thing I think about investing is my job as an investor is to find the best investments for the type of risk that we're trying to go after. But we're also, there's common term risk adjusted returns. It's pretty common to say that, but really you are trying to counterbalance that risk by segregating it out or finding areas where you can get growth without having to take a substantial amount of risk. I can appreciate a private equity investor returning commitments to investors because they're just not feeling comfortable with the landscape. Right now, there are a lot of interesting investments in, I'd say, hotels. Risky. Yes, it is risky, but the hotel industry, in my opinion, isn't going away. And so you can buy a lot of hotels for really cheap. So there are lots of good investments there. Relatively low risk. These buildings are still good buildings, but others could say, hey, that's just crazy risk and I don't like that. So as I think about working with my clients, one discussion might be, hey, I've worked really hard for this money. I've made my 10, 20, $30 million. I don't want you to lose that. And so the way we're investing is much different than another individual who says, I've got some money set aside for a rainy day. I want you to just go take as much risk as you can, obviously preserve my capital, but I want you to get the best returns possible. Then we'll focus there. And there are a lot of investors I'm talking to right now where if you want to get into the next high flying startup, we can do that and we can have a lot of fun there. But you have to be comfortable knowing that if you've got 10 million, it could go down to 5 and be okay that could be the result. And don't get mad at me, but it's always a discussion. It's an evolving discussion where we focus on what are we trying to achieve. And I've seen portfolios go from 10 to 12, and I've seen them go from 10 to 100 based on the investment objective.
So let's talk about the election without getting into the politics of the election. But recently we went through the results, and before the results were tabulated, there was a tremendous shift in the market. And just yesterday, a couple of days after the election, one of the ETFs, I think it was a QQQ Power Shares Invesco, was funded with $3 billion in a single day. Obviously, it affected the rate of growth. So it across the industries, the election impacted some industries and not others. Comment for the long term. Is there a message going on in Wall Street right now? What's happening?
Yeah, well, if you think about investing, we'll say you buy S&P 500 ETF to keep it very simple, broad market. What are you buying? You're buying the potential for earnings growth. Those underlying 500 companies, as long as earnings keep going up, the price of that ETF will go up in value. So you're going to make more money than you did yesterday. Everyone is hoping for that. But when you think about investing, yes, that's the fundamental piece of it. But then there's also the supply demand piece of it, or just the kind of the speculative side, if I'd call it. Markets hate uncertainty. The election, there was so much uncertainty leading up to it. And even today, here we are in the middle of still finishing the count. We may have an idea of where it's going to go, but nobody's going to call it yet. And markets, though, have kind of a sense of, well, we've seen a lot of the results. We're 95% of the way there. Markets love that, and so they're devouring it. And so markets have gone up tremendously over the past 3-4 days. That's right now, but this is all short term. When I think about investing, I'm a long-term investor. Don't ask me to buy a stock and day trade it for you, because I will do a terrible job. Because, well, if it's my own money, it's emotional. And so you get worried and you get scared. If you ask me, hey, I want you to buy, somebody asked me to buy Palantir, and I said, great, I'll buy Palantir. So I did that this morning. But when I'm buying that, I'm buying that for the long run. We're looking at a 12, 24, 36 month horizon or longer. And so we're still looking at the fundamentals. And so when I think about what's going on in the world, what are the big things that are affecting markets? I think a big one right now is the whole tax piece. Our tax is going to be changed and adjusted. If we go from a Republican-led government to one that is either mixed, where you have Republican, Democrat, maybe you can't get anything done, or the Democrats have more control, we are going to see changes. And so markets are going to respond to that, because earnings, whether it's corporate or individuals, those earnings affect the outcome of all these companies. How are consumers spending? How are these companies going to spend? Are they going to hire more employees? Are they going to fire more? And so overall, then you get to inflation and GDP growth. And so for me, I have a long-term view on markets. Do I think they're just going to keep ripping like they have in the past 3 days? Definitely not. We're going to see a lot more volatility. But if I were to say, okay, here's where we are today, and where are we going to be 5 years from now? I expect us to be up overall. That's just how markets are. The economies continue to grow. But if you ask me to pin down what is that number, what's that percentage, that's the crystal ball that everybody wishes they had.
Any thoughts on the monetization of the debt, the way that they continue to print more money to fund the outstanding obligations?
This is a tricky one, and I'll try to keep my
and I'll just
political views out.
I'm not sure there's a right answer, but
yeah,
just want to get a philosophy of what you think.
Yeah, no, I agree. I'll keep my views out of it as far as think about it politically, but debt is a hard one, because say you're printing money, or say government's doing government spending. Basic economics say you're helping the economy grow because you're giving people jobs and you're keeping people employed. High unemployment is bad. Sometimes it's okay to be in a world of hurt a little bit. You think about the Fed and how they are continually buying bonds, and they've went from very safe bonds to corporate bonds. They really stretched the bounds during this pandemic year. And so you look back at 2008, markets recovered, and actually recovered quite quickly, relatively speaking, and they have been supported over the past decade. Well, how much longer can you keep that going? Is it really sustainable? And you have to worry about the next generation, and are they going to be in a world of hurt? So I'm constantly scared by that. And while as an investor, as I think about my money, there are signs where I think about, okay, should we be taking on as much risk as we have? Should we be paring it down a little bit? Right now, things are going to keep going. And until the Fed stops doing their buying, by all means, you want to stay invested. But it's really hard to call that day when something changes. What's the next catalyst? And we do have, say a downturn or bounce back. They call this a K-shaped recovery right now. Markets dropped a ton, they've bounced back very well for the wealthy. Individuals who aren't as wealthy, they're actually in a world of hurt and it's getting worse. Does that affect the overall economy? Does that change things? I don't have a strong answer necessarily, and that's one that I think most economists are still trying to figure out.
How does a person that just says, "I'll just sit on the sideline and I'll cash"? Do you have a comment to those individuals that don't want to jump into the market because they're afraid of a downside?
Yeah, well, it's very much, I'd say it's actually a personal decision. And if someone told me I want to be in all cash, at prior firms that I worked at, you're told that's crazy. Don't let anybody do that. They need to be invested. Partly because somebody's not going to get paid fees because they're sitting in cash. But if I were to take a step back, cash erodes value slowly over time because it's not going to keep pace with inflation. So you've got to at least do something to keep pace with inflation so you can still pay your bills, or you're over time going to become less wealthy than you were a year ago, 2 years ago, 5 years ago. That said, being in cash sometimes is the best investment. But I'll give you an anecdote. I had a client who, from 2015 to 2020, said, I want to be in mostly cash, and I'll do a few investments, and I'll do a little bit of venture capital, which is counterintuitive to wanting to be in cash. But they were very, very conservative. And over that period, markets just went up and up and up and up. Then March of 2020 happens, and they dropped tremendously. And they emailed me, and they said, look, I was right this whole time. It was better that I was super conservative and I was in cash. And my retort to that was a good decision if you had that 8-ball to be in cash during the month of March. But you left so much value on the table by not being invested over that 5-year period that your portfolio is less than half of what it could have been. And so, end of the day, yes, if you're trying to be if you're trying to optimize, which is a word that I use a lot, I'm an optimizer for my clients. That's great. And that's what we're trying to do. But if you can't sleep at night because you go to bed and you're like, I'm in a portfolio that's too risky, I'm worried that I'm going to leave something there and I'm going to lose value, I've worked so hard for this, which everyone has, well then don't take the risk. And so that's where you play into those emotions and you have to find the right balance.
Great advice. Robbie, I appreciate you being on today's show. Been visiting here today with Robbie Shattuck. He is the founder of Athos, Athos Wealth Management. Robbie, if someone is to contact you, how would they go about that?
Yeah, there are lots of easy ways. You can find me on Google. That's an easy one. I have a website. It is athoswealth.com. So ATHOS wealth.com. And my contact info is on there. I also have a contact form, so it's very easy. You can call me, email me, text me, WhatsApp. I accept all communication, as a lot of my clients prefer to do that. So,
excellent. Thank you for being on today's show.